All right. Hey everyone. Welcome to the podcast or video, I would say today, with Savani Real Estate. My name is Avin Savani. I'm just going to be going through today some in-depth evaluation of different markets and kind of a step-by-step of how to evaluate a market and the different sources that I use. So if you're a beginner, you're starting out, this video is fantastic because all of these resources are pretty much free, and you can utilize these by just searching them up and finding the results related to your market that you're researching. So just going to be going through also building off of last videos. So we did CRE risk mitigation in the last video. So realizing all the different property risks associated, the macroeconomic, the property condition, the capital stack, the relationship risk, and obviously the operational and execution risk. So as you're going through this, keep in mind there's a lot of moving parts, and kind of like speculating about things and making assumptions based off of speculation is not the best strategy. So I always recommend that when you're doing this, at the same time, still communicate with your network, talk with brokers, talk with property managers, contractors, see if you can get some rough pricing on the projects that they have going on, so that you can at least verify some of these assumptions. So obviously like rent growth, occupancy, vacancy, operating expense growth, also like the individual items within operating expenses. So all of those items are really necessary to solidify like in your market, and having like a local property manager who's knows a lot of vendors for like HVAC, electrical, plumbing, roofing, exterior landscaping. All of that is really valuable. So I highly recommend talking with a local property manager and getting some idea of what the pricing is in that market. So as we're going through this, keep in mind that this is all research from the internet. So there may be some variance as far as the accuracy of this data. And obviously, when you scale up your business, you get more units under your portfolio. Then it's probably wise to invest into a solid data source like Yardi or CoStar, or Reonomy or something like that, so that you can at least verify and make sure that the data is accurate. But nowadays, it's really hard to find like good data and data that you can trust, because there's so many opinions about like I don't know what the average rent growth in that market is, what the operating expenses in that market, and overall just opinions on things that are kind of confusing if you're a beginner. So I'm just going to try and go through this as kind of in-depth as possible and explain things slowly, so that you guys can really understand where I'm kind of coming from, and my opinion on it as well. So yeah, so I'm just going to share my screen here. So this is where we left off last video, just going through the risk mitigation techniques. So the first one, obviously, macroeconomic risk. This is your market risk, things that could affect the appreciation on the property, periodic performance on the property, right? Affecting occupancy levels, affecting your operating expenses. So all of that, also coupled with development activity within that submarket, is also going to impact or drive customers to your front door. So it could increase leasing demand. It can increase better property management performance, like outlook, essentially. So you'll get more people maybe interested in renting your apartment. You could get a lot more leads and more applications filled out, and eventually leases signed. So all of these things are the top kind of broader view, and then they filter down into the micro view. So as you're going through it, so I said here, comfortable with your target market, and so the demographics, obviously, population, job growth, affordability, supply and demand characteristics, the major employers in that market, universities, If there's economies of scale with good diversity of office, retail, industrial, life sciences, medical space, and overall, like people, brokers, contractors, developers, they all like are like kind of attracted, and it's like a magnet for all of them to perform their work, you know. So that's kind of what you're looking at as far as the economies of scale. And then obviously keep in mind, if you're doing some larger renovation project, you need to add additional units, and you may need to want to increase like the story or the floor area ratio of your facility. Then you need to keep in mind of the restrictions from the township, the uses and setbacks, conditions, covenants, restrictions, all of that, and just review that your project is feasible within those guidelines. So yeah, and then obviously landlord tenant laws are huge. Many areas are tenant friendly where there is rent control. There's more acts and kind of laws that go in favor of tenants. So keep in mind that that you have no rent control. Honestly, if you're investing in market rate apartment buildings, obviously with affordable housing, your rents are capped to the area median income. But with regular apartment buildings, it's better to have that flexibility of no rent control. And then also having a smooth eviction process as well is very key. Just because if you have class C or class D like tenants, you know, and they're obviously not credit worthy enough to stay in that facility, and they haven't really showed the responsibility of handling their particular unit, then the eviction process is definitely something landlords exercise. And if it takes like, I don't know, 4 to 6 months to just get one tenant evicted, it can definitely have a hit on your performance and the bottom line cash flow, right? So yeah, and then as we're going through this, obviously property condition is addressed to that particular property that you're investing in. So pick a market first, pick a market that you like, research on like brokerage sites, off-market sites, which one that you'd like to invest in, whether it's like garden style apartments, 3-story high rise, value add class B minus to all the way up to like an A minus, or value add class C plus all the way up to B plus, you know. So see like where your strategy can really mix in. And then obviously from there, it's a matter of doing your due diligence with that condition, right? So that's that. We left off there. And then capital stack, obviously structuring the debt accordingly to your business plan. With value add, many people like to get bridge debt and then convert that to a permanent fixed rate option. Whereas people who are investing in stabilized assets, they can just get fixed rate right off the bat and not have to worry about going through that process, right? So swap rates are also very valuable. So basically that gives less hassle and more flexibility to just go straight from the adjustable rate, floating rate into the fixed rate, right? So that's the capital stack. And obviously with equity, if you're a smaller investor and you don't have that much equity, it's very wise to partner with a joint venture partner or an institutional retail investor who has that expertise. Maybe they have somewhat vertically integrated operations. They have their contractor relationship down. They have their property manager down with them as well. So it's wise to find those people in your market and see if they're willing to transact with you. So yeah, and then obviously raising capital is another story. So if you're at that scale where maybe you have like 100 units under your portfolio, you have some trusted property managers that you're working with to maximize the performance on that. And then you've also established a lot of good contractors in that market. Then it's wise to maybe take that step into actually going through the syndication process and filing that 506B offering or 506C offering for your investment project. So that's another story. But the other thing is obviously relationship risk. So I noted here all the key teammates, key principal, the sponsor, which is you, the investor. You have your limited partners, you have your lender, your real estate agent, the attorney, the contractor, inspectors, architects, engineers, property manager, and the CPA that's involved as well. So those are like key people that are gonna really bring your deal to fruition. Obviously, it starts out with the broker lender communication initially, and just seeing if you can keep up deal flow, become more knowledgeable about the markets, and stay prepared. I think being prepared before you make any type of major capital decisions is the best thing to do. So keep in touch with them, learn more about the markets, do your research as far as meeting with like tech companies or people who have access to a lot of good data. And then also knowing which type of debt offering that you'd want to close on with the project. So it ranges. There's plenty of debt offerings. There's the agency route. There's conventional route. There's CMBS, life insurance loans. There's debt funds. So just be mindful about what's out there and then what you can possibly close on with that project. So yeah, that's that. And then obviously the operational execution risk, that's later down the road. That's you performing the asset management with your property managers, scheduling bi-weekly calls with them, checking in on the KPIs. There's maintenance issues, tenant relationships, and then also just tracking like budgeted versus actuals. So the underwriting initially from the acquisitions team, they'll have all the CapEx budgeted items. They'll have all the operating expense budgeted items. So just matching those, seeing where there's some discrepancy or larger variances, and fixing that. Meeting with like the contract service people, and seeing if you can negotiate a better deal with them for, I don't know, the landscaping contract, the pest control contract, the snow removal, trash companies, right? All of that stuff should be negotiated right off the bat, and seeing if you can achieve that budgeted cost. So yeah, and then staying connected with them, obviously, having a solid property management software is key. Many times, lots of companies, especially if you're third party managing all of your assets, you're going to get into trouble with learning like 4 or 5 different softwares. So with that scenario, I highly recommend that either you choose like a property manager in that market that sticks to one software, and they're also just managing most of your assets, or invest into like an asset management software where you can kind of link or perform like API integrations and get all your data and everything into one location, and from there you can obviously perform the portfolio analytics and the data investor reporting from there if you have investors in the first place. So that's that. And then obviously accurately kind of defining out the refi period is also key. So we'll get into all of that, but essentially we're going to be just going through 2 to 3 markets today, and just showing you my process of how to evaluate it thoroughly. So starting with the basics, like the population, job growth, those figures, and then getting into some of the more nuanced things that people kind of overlook, in my opinion. So yeah. So as we're going into this is kind of a spreadsheet that I keep for all the markets that I'm looking to invest in, right? So for instance, with Nashville, we're going to start out with Nashville, and then we're going to go to Raleigh-Durham in North Carolina. So 2 markets that I've been very attracted to and have been very impressed with their performances, especially during a tough time like this, and seeing the resilience of the market. So essentially you start off with population growth. the median household income, the median condo or house value, the crime index, and then also the job growth. So these are like the key fundamentals that you should start with. So sources that I use for that, obviously Census Bureau is great. Now they don't update this routinely. They do it like every 1 or 2 years. So keep in mind about those figures that they might be a little bit lagged, right? So first off, you're just looking at the growth from 2010 all the way up to 2022, which is what they have here. So 601 to 683. Then you're looking at the average household value from 2017 to 2021, which is 291. And then you're also looking at the median household income. You could look at it on a per capita basis, which is like per person, but I like to look at it as like a kind of a family household value. It just makes it like more accurate in that sense. So 65,565 is the value for that. And now they don't have figures from like 2000s or like 15, 20 years ago. So a source that I use to get that like historical value is citydata.com. Very popular. Many people use it as like a quick free resource. So they have a lot of good data within each market. So with the Nashville-Davidson County, you'll see here you have I believe you have 39,000 and 2,000 for household income, and then household value you have 111,800 for that. So this is great. Lots of other stuff that's here as well. So you can see kind of a heat map of where those areas are for each type of data source. You can see the demographic breakdown. Let's see here, a bunch of other things like taxes, like the growth in taxes, I guess. But we're going to rely on something else for that, and I'll show you that in a bit. But yeah, I don't want to get too much into the weeds here. There's a lot to go through. So those are just two that I use for those basics, the top three, which is population growth, median household income, median household value, also crime rates as well. So I wasn't able to find something for crime rates for the city of Nashville on this site. So another source that I like to use for that is Spot Crime. So Spot Crime pretty much gives you the exact type of crime that's happened. And then you can also just see that kind of on a map, so you can see where those actions are happening. So first off, I'm just going to search up Nashville, Tennessee. You'll see here that this is a pretty large market. So I'm going to zoom out here and then quick search this area. So actually, I have to get more closer to search the area. Okay. As you can see, some of it isn't that accurate. It's like the same things kind of just like popping up here and there. It worked really well for the more dense cities like Philadelphia or Washington, D.C. You were able to see like when you zoomed into a particular submarket, everything that was happening. But you'll see here that this amount of crime pretty much follows wherever you go. So that's kind of a little bit misleading. I would just see any major thing that's happened. So for instance, a shooting is obviously a major like catastrophic event. And that also has long-term impacts on perception of that area too, like whether it's safe to raise a family, honestly, in that area, or safe to even live there in the first place, right? So shootings are a big red flag for me. Now you got some burglary items. You have other items which aren't categorized. You have some assaults. So what else is this? Theft, right? So different ways that crime is happening. So for instance, if you go here to this area. Okay. So it does work. So you saw how I like zoomed in into a submarket and you were able to find like what exactly is happening. So that's a good strategy to use with this. So for instance, if I'm going to be researching like Murfreesboro, which is somewhere down south here. Yeah, right here, Murfreesboro, right? So I click search this area, and now you see like some really bad things happening, right? So you got some shootings here, which is really bad, and my prayers go out to that school shooting that happened in Nashville. It was a horrible event. And yeah, so it's good to keep be mindful about this when you're investing in a property, especially when you have that historical negative impact on a community like that. So keep in mind about that. You got some burglaries here in Murfreesboro, some theft, right? So you can also just click more information to actually see like the case number and like the police report on that as well. So that's a good thing to keep in mind. But yeah, so that's crime in a sense, and the major items obviously shooting as well as burglary and theft and assaults. Those are things to just mitigate right off the bat. And if your area has a higher frequency of those things happening, it's better to look the other way into another market, right? So yeah, so that's kind of for crime. And then the other thing was job growth. So obviously, Bureau of Labor Statistics has fantastic reports. So you can go to each and every state in your state in the nation, and then within that state, you just click on. Let's say I clicked on Tennessee, so it took me to this site right here. I'll just go back. So it took me to this huge site which had every single submarket and city, like MSA city, in that particular state. And then you'll get PDF reports that are pretty much updated like monthly. So that's really good that they've like keep this updated and gives you really good real-time data in that sense. So for instance, Nashville, I clicked on that and you'll see here just a quick breakdown of the areas in Nashville. So you have Williamson, Davidson, that's the main county. You got Sumner, Robertson, Cheatham, Hickman, Murray. So you'll see the unemployment rates broken down there. You'll see, now this is what I look at the most. So this will give you a quick indication of how your total like market is performing. Now you could get more granular in that sense, but honestly, if you're already going more specific within that city, right, you can just rely on that number. But I get it. You can definitely get more granular with this. So total non-farm payroll, basically this is in thousands. So you'd be taking this number, you would be adding this percentage to 100% pretty much, and then taking that like 1 plus like 4.6% and dividing that into the non-farm payroll. So if you have non-farm payroll at 1154, you do that divided by the 1.046, you'll get what the non-farm payroll amount was a year back. So then now you can do the rate of change calculation and just verify that it's 4.6. So again, the rate of change calculation is pretty simple. It's final minus beginning divided by beginning, always. That's how you calculate rate of change. So that's that. And then 12-month percent change in the CPI. That's also pretty interesting. And then you have the PPI, which is, I believe, the producer price index. And this is the consumer price index. So you can match those up, kind of see where the discrepancies are. So producer price index, you're mainly tracking general freight trucking, hospitals, transportation equipment, and manufacturing. And then on the consumer price index, you're tracking food, energy, and all other items. So yeah, a big component of CPI is obviously rent. So another figure that you can search up on the Fed's website, but pretty much it's core PCE, which is core personal consumption expenditure. So I'm pretty sure they leave out food and energy in that, just because those are essentials. But you can kind of see where that's like a net kind of inflation metric that you can use. But yeah, so now you get to see the average hourly wages for the occupations involved. Obviously, Nashville is a huge soul town, so you got musicians and singers making up a huge majority of that. And I've also heard that on a lot of apartment buildings, some, like, especially if you're in an area where there's a lot of music activity, like renters like to have producing rooms in their apartments. So like soundproof rooms, producing studios. And that's like a huge like value add, in my opinion, if a facility has that. So yeah. And then you got some employer costs here. You got the wages and salaries as well, 12-month change in the employment cost index. So great report that BLS puts out there. So that way you can solidify if your market is performing up to standards as far as the job growth, right? So that's that. Now, other things, now we're going to get more specific into our market research and evaluation. So first thing that I like to look at off the bat is just doing also just like a quick Google search, right? So, I mean, map search. So you're going to go into your submarket, right? And so I'm just going to click on maybe one submarket that is an interesting one. So why don't we do Radnor here? I don't know, honestly, like anything about Radnor, but we'll see, like, based on how this is broken down, whether it's an attractive market. So we take our little dude, we go into one of the residential communities, and then we just drive around, So this is great. Like I love doing this because obviously once you get like the listing down and you have your actual listing that you're researching, then it's easier to do it. Like I'm just doing this randomly right now, just like driving around, see what it's like. But it's better to just do with your listing, go out like a mile, explore the different blocks and streets, and just make sure that there aren't like too many like suspicious or also just like distressed assets within that facility. I mean, that area. And that's just another thing to keep in mind, that also if you see some units under construction, or there's some excavation project, or you got some grading that's happening on a lot, right? That's a good indicator that there's good developer activity. And that's another thing we'll get to, is the supply and demand characteristic of markets. So here you can see here that there's some retail shops, you got some restaurants, you got gas stations. So all positive things. You got an Applebee's there, you got a Guitar Center. See, the vibe's already there. You got like a burger shop or something like that. I don't know. Yeah, that's a burger shop. You got a paint store, Sherwin-Williams. That's a good thing. So yeah, just kind of driving around. That's another tip that I suggest doing. And now going into the contractor developer activity. So I did a lot of research as far as which brokerage platforms provide that report. And honestly, the best one that I could find is from Berkadia. So fantastic. They perform these construction pipeline reports quarterly, and they give each and every market within that on their website. So really recommend checking that out. But this is another thing that I suggest, just to stay organized. So I keep like a folder of all my market research. So whether it's national research or depending on the submarket, that's kind of like what I like to keep. So I'm just gonna like make it a little bit more precise with the regions. So for instance, the Southeast region here, all these Nashville market reports I put into Nashville. So, first off, Nashville, right? So, what are we looking at? So there's four stages primarily in commercial real estate as far as going from uh, ground up all the way to the stabilized product, right? So you have your planned, right? Planned projects, which still need to go through the legal entitlement, insurance phase, and all the due diligence items associated with that plot of land. And then you have the prospective projects, which have gotten township approval. They've got their development agreement. They've also maybe solidified their permits and they're ready to start construction, right? And then when you get into the construction phase, you have it under construction. And then lastly, you have the lease up phase, which is the product is complete. They've held their like grand opening ceremony or whatever it may be. And the property management company has occupied the facility now, and they're doing their marketing and their leasing activity to attract all their tenants, right? So those are like the four phases that you can see broken down in some of these reports. And I've kind of gone over this in the past, but basically you can go through each market that you're looking to invest in and see how that activity is kind of developing. So for instance, you can see it broken down into all the submarkets in Nashville, the northeast location of Nashville, down to the southeast and down to the south portion, and then near this area, I think Franklin's like north of Nashville, right? No, I might be wrong. But anyway, so you're gonna go through this, just see where your property is located and if there's some good activity happening. So another great source that I like to rely on, and then they have it broken down here as well. The address of the facility, the completion date, the permit date also, and when they're finishing their value add program or their renovation project, right? So the start of the rent up essentially. So that's that. And obviously there's a lot here to kind of unpack, but always just base it off of where your market is. So you see here the submarket listed, categorized. You have Franklin, you have Nashville Central South, you have Murfreesboro, you got Vanderbilt, Southeast, Central South. I mean, just said that downtown Nashville. So just break it down where your property is and go from there. Okay, now another source that I like to use. Obviously, we'll get into the cap rates, but as we're kind of going through this, once you have done like your yield on cost test to see if your project is at least somewhat feasible, and you're realizing a good spread between the market cap rate, the seller's underwritten cap rate, as well as your underwritten cap rate, then it's a good idea to underwrite it fully, plug in the T12 and the rent roll, and then also justify all of your assumptions. So first thing, some risks that I like to mitigate right off the bat is obviously rent growth. So rent growth, you can get this from other sources, but you can also just see on apartments.com where your average rents are within that market. So if I go to Nashville now, I know this is very broad, but since Nashville is a huge market, but as you're going through this, you'll see here all the different products that are available for rent, and then you can categorize that. So start by taking your unit mix, whatever it may be, studios, 1 bed, 2 bath, 3 beds, whatever the range is, and then filter it out into these types. So you'd start off with your 1 beds, probably start with the studios, studio to 1 bed, and see where those rents are at. And they don't have like averages or anything, but that's just a good sense that you can get as far as The price, you can't really sort this by square footage, so like price per square foot. But that's okay. Just see like what the price is at for that unit, and then see where your rents are at according to the seller's rent roll, and also what they've done in their performa, right? So apartments.com is fantastic. Another one is hot pads. So same thing, Nashville, Davidson County. Go with 1+, search it, and see where those rents are at. So start with the low price items, just see those facilities. Also just click into one of them, see how it's looking from the inside. Not too many pictures. You can see the rules with that facility, the floor plans, how many square feet. This one's obviously not very accurate. Apartments.com honestly does a better job of going in depth about their listings, and I'm pretty sure it's like all brokers pretty much list to apartments.com. There's other sites out there, obviously, like rent.com, I think is another one. But anyways, just find like one source that property managers use, and then click on one facility. So here I'm just going to click on this facility. You can see who's owning the asset or managing the asset. You'll get the floor plans here. You'll get the average price for the floor plans. You can also maybe do a 3D tour on that floor plan. You can see the amenities listed here. And then they should also have rules. So like pricing rules as far as who is paying what. Okay, so there you go. You got the pet policies here. You got the fees, right? Parking fees, administration, application fees, and then the lease options that are presented. So that's great. And then also this is great. I love that they do this, is that you can just get a quick snapshot of that local market. Just see everything that's involved there. You can see the education nearby. We're going to get into another source with that as well. But yeah, this is great. Transportation is another key element. So having like good visibility with your project, easy access to a major corridor or a highway, and also having it in a prime location where it's nearby universities, all the major employers, and also that it's not on any type of risky land. So when I say risky land, first thing that we're talking about is floodplains, right? So I kind of did a quick search as far as Nashville County's floodplain, right? So this is Nashville's floodplain. So you can go onto their county website, or just type in like Nashville County FEMA floodplain, and this will show up. So you can get a sense of where the floodplains are. So there's the legend down there. As we zoom in, I don't know what's happening here, but that's how you find out if your area is in a floodplain. And then so you have here the different specifications. So this is area with flood risk due to levee, area with reduced flood risk, without base flood elevation, with base flood elevation, approximate location based on user input. Okay, so I'm also a little bit lost here, but I just like recommend just talking this over like with your team, also with your site engineer. I think that's also very wise. Just talk it over with your site engineer. See what some of these items like mean, like whether this is a very risky floodplain area or not. and just get their advice and then produce that report from here. So I think you'll be able to get a report from the county website, but I just recommend just calling and asking if they provide FEMA reports. So that's that. And then this is school locations, right? So basically you'll get a breakdown of all the elementary schools, middle schools, high schools, maybe even college. So you can see here, they don't go up to college, but anyways, but on apartments.com, you saw like colleges as well as like schools, right? So major universities, see, you got here Vanderbilt, Belmont, Lipscomb, Trevecca, Nazarene, right? So all that is fantastic. And you can also just make a quick summary of this and just highlighting that in your investor memo, just highlighting all of these main points. Like it's in a great location, you have universities nearby, you have the best high schools and middle schools in town, and you also have fantastic employer activity, maybe major like retailers in the area like Best Buy, Walmart, Costco, Target, Giant, right? So highlighting some of those points and just noting that it's a very family friendly area, that there's reduced crime over the years in that area, right? So all of that stuff creates a better story and an image for your product, right? So that's really important to just find out right off the bat, and just implement that into your investor presentation, the investor memo, when you're either raising that capital, or you're also just presenting this to your lender or your other third parties involved, like your contractor, your joint venture partner, right? So all of that, right? And now this is another thing that I researched is for property taxes, right? So that's a huge item. How often do they reassess property taxes? So it's a wise idea just to call the assessment office within that county and just ask them that, hey, I'm an investor looking to purchase an asset, and I wanted to know how often your county reassesses taxes, right? So depending on that, and then also asking if they have some type of data as far as maybe just an example property that the growth rate on their taxes, just to get a general idea how you can underwrite your property tax growth, right? So yeah, and as you're going through this, you can research it by the address. So obviously you need a more specific address. It's not going to really come up if you have the main submarket, but yeah, I'm sure from here you'll be able to see what those taxes are for that property. So you'll have an assessment value, you'll have the city taxes, you'll have the county taxes, right? So a breakdown of that is actually available if you go back here. I found this for Nashville is that you can estimate your particular taxes, right? So here they have real property taxes and personal property taxes, but as you're going down here, they'll have a quick step-by-step on how to do it, and they can also just do it straight for you, depending on that assessed value, right? So yeah, and then oh yeah, this is another thing. So this is where you can pretty much find the tax growth rates. Now it depends obviously on the asset type, and what the zoning and the property classification is, right? But this is just a breakdown of where you can get that growth rate. So whether it's a tax cut or a tax growth, right? You can see how it's done year by year. So that's a really cool way to see it. So here you have GSD and you have USD. So I'm also trying to figure out what the difference between those are, between USD and GSD funds. So I guess it's a different currency, or I have no clue. But anyways, your county will have most of the information. It's wise to just establish one contact with the county and just learn more about it. Here's another instance for getting rough title reports and closing costs quotes, right? So for instance, on the national.gov website, you'll see here for the conveyance of deed, and then also the mortgage recording. There's a tax for that, and so they do it per $1,000 of your property value. So depending if you have $1 million property, then you'd end up paying $3,700 for your conveyance of deed, and then you'd end up paying $1,150 for your mortgage recording, right? So yeah, so that's that. And there's also like a whole deed recording page here. You can see calculate register of deed fees. So these are the different types of deeds that are available, and then you can do it based off of which one that you've closed your property with and calculate that fee. Another thing is just to talk with a title company in that area that does title abstracts, chain of title, all the necessary reports when you're verifying your title. So for instance, this is one that I just searched and I found. So for instance, based on the location, if we're doing, let's say, Murfreesboro, our purchase price is $1 million. Our loan is $650K at 65 LTV. What is the transaction type? Purchase is a property in Hamilton, Knox, Montgomery, Rutherford, Shelby, Sumner. I'm not too sure, but basically, this is just a quick estimate. So you'll see here settlement fee, doc prep fee, doc storage, recording services, title insurance, lender's title insurance. I don't even think that's a thing, but recording fee, you got your warranty deed, you got the transfer tax as well. So this is great. And you see that transfer tax, 3,700. That's what we found here when we went to that conveyance of deed. But that's I feel like that's something different. That's the conveyance, and this is the transfer tax. So it might be something different, but maybe that's what it is. But I'm also kind of new to this as well. So yeah, so that's a good tip that I say is just talk with your title company in that area. See if you can get a rough quote on all your closing costs when it comes to transacting. So yeah, quick little thing on title report fees as well as property taxes for your particular area. So these were all the sources that I used for just finding what your local market is performing at. And the other thing that I recommend is just relying on some tech companies and their data. So for instance, RealPage and Yardi, they have fantastic webinars and reports that they do on a monthly and quarterly basis for each like market, also national news, all of that, right? So for instance, with Yardi, you can just verify what your local market is looking like. So for instance, I'm pretty sure they have rent growth figures for each and every market. I'm gonna try and find that somewhere here. And again, just talk to your broker about this too. And probably be wise to talk with a buyer side rep for this, just because they have your best interest in mind, and they're going to find the best market and the best property that your project is going to reside in. So best to keep a good relationship with them and become more knowledgeable about those properties. But Anyways, here you'll see rent to income ratios. That's another thing for affordability. So basically calculating the annual rent that you're going to be paying divided by the annual median household income that a family receives, right? So you have this broken down into, obviously New York is the most priciest market, but you'll see all the different markets listed here. Now this is change in rent to income ratio. But if you can see here, just see where the percentages are. For instance, do they have Nashville here? I'm like tilting my head sideways to, oh, there's Nashville. Okay. So Nashville's at 31.2% rent to income ratio. Over the year, they've seen around 0.7% increase in that, which isn't terrible. Obviously, the 25% rule is what I keep, just because if you have 25% set aside for your rents, maybe 25 to 30% for your personal debt, and then also 30% or 20% for spending on lifestyle things, such as going out to restaurants, to movie theaters, or living like a normal sustainable life, you know. And also for all your food, your necessities, your clothing, all of that stuff. So that's like 20% within a year, right? And then the other like 20 to 30%, you can invest in, like whether it's stock markets, whether it's real estate, whether it's any type of investment that you'd like to make on your behalf. I think that's a really good rule that I keep, is the 25% ratio. Now, obviously, with markets, you see here that none of these are actually meeting that 25%, just given the priciness of some markets. But you'll see that some sub-markets now, so these are all the major MSAs, they're going to be more expensive. But the sub-markets and the tertiary markets, that's where you can realize better rent to income ratios. So yeah, that's a good thing to keep in mind there. But here you also have other markets, sub-markets. So okay, so they are highlighting some sub-markets, but you got some regulatory things in place as far as the acts and the different rules and regulations passed by jurisdictions. And then this is a cool thing that I like took a while to kind of just like interpret. It's just a bit breakdown, or like a heat map kind of the fundamentals, the infrastructure, political risk, and the environmental risk. So now obviously it's there might be some like hidden biases here, or this might be not as accurate, but it's still cool to see like what their perception, this is Yardi, by the way. So what Yardi's perception is on different markets. So you'll see here, let's just quickly look at Nashville, for instance. So you see 2, 3, 2, 2, 3, 2, 3. So relatively solid. The ones obviously with more red are higher investment risk, right? You got some other data there. I'm trying to find that rent growth figure. If I can find that somewhere. Yeah, here you go. They got 3 month-over-month rent growth. Not what I'm looking for. I'm looking for year-over-year. Year-over-year rent growth. Here you go. So, oh, these are tertiary markets. Okay. Did the other thing have year-over-year? Did I miss it? Oh, okay, so it did have it. Okay. So, here you see Nashville. That's occupancy. What am I? Oh, year. Okay, it's right there. Just read it. Sorry. So Nashville's year-over-year rent growth is 3.2%, and then you also have a year-over-year occupancy growth at negative 1.4. So not terrible. Obviously, given this market, you're seeing lower occupancy and more rent cuts in major markets, right? So this is all normal. This is signs of stabilization. Obviously, you'd like to see occupancy get a little bit higher than what it's at right now, but it's just the renter's market, honestly, at this point, right? So the cost of living in or buying and owning a home, that average like monthly mortgage payment, along with all of the utilities, taxes, all that. So the monthly expense for owning a home versus the monthly expense for renting is drastically different. So you're seeing tenants hop in and out of different facilities, especially if they have the credit worthiness, right? And taking advantage of that renter choice, right? So just a good thing to keep in mind as far as the current market, but obviously heading into next year, I'm predicting that we'll see some stabilization with that. Yeah, so now for rent growth, it's a very sensitive topic. It can pretty much have a underwriting return like structure go from really bad all the way to really good just on just inputting rent growth, and the other way around too. So it's very good to solidify this with multiple sources. So that's why I use Yardi. I use where's the other one? RealPage, right? So RealPage also produces the rent growth within each market. So you can see here rent change, annual average rent change per market. You'll see Nashville is probably also in that 2 to 3% range somewhere, or it might be something different depending on the data. So yeah, 3 to 4%, same range as the other one. You can also get some occupancy statistics, and then also you can get average rents for the different classes. So you got class A, you got class B, class C, and so on, right? So and then also quick activity as far as the supply demand, which I've already noted in the Berkadia report. So anyways, these assumptions, start by doing this market research with the tech companies, maybe also reviewing some brokerage reports, and then also just talking with your broker or your real estate agent just to get an idea of what their opinions are. They have access to CoStar, they have access to Yardi, so leveraging some of those insights from them and seeing how your market's performing is a wise idea. So yeah, you got some new lease trade out and renewal lease trade out data there. So that's really cool. You got occupancy statistics. You got year-over-year effective asking rent change. So this is effective asking rents is obviously net of concessions. So concessions are obviously free rent that you're offering your tenant. So after you get your gross potential rent, you subtract out the concessions, you get down to effective asking rent. So now you'll see here that Nashville is still in the same range, 3 to 4%, somewhat below the US average, which is 3.9%. But again, this is a market where we're seeing lower rent growth, we're seeing lower occupancy. So we're in a transition period right now as far as gaining that stabilization. Now you'll also see here, which is pretty cool that RealPage does this, is the average cost of operating expenses. So and year-over-year change, honestly, for that too. So you have insurance skyrocketing. I've heard a lot of stories about insurance, nightmare stories about like pretty much premiums going through the roof. And so that's a good thing to just keep in mind. Talk with some agents and see where the pricing is at for that. Turnover costs, that's if your unit gets vacant, you have to clean it out, or all those turnover things that you need to kind of absorb, like repainting. Maybe there's some they hung up a lot of photo frames or something like that. So having these rules also specified in your facility to minimize some of those like rehab expenses is a wise idea too. So turnover costs can definitely be burdensome. Then you have utilities, administrative, operating, maintenance, payroll, and marketing. So some good things to just mitigate right off the bats, and also negotiate with your service provider. Okay, so that was just a quick breakdown. And now lastly, this is another source that I use, and you can also use by just researching online, is a cap rate survey. So CBRE, popular brokerage firm, they produce this on a semi-annual cap rate survey, which gives insights as far as which asset class is performing or outperforming others, right? So here you'll see just a breakdown of all the multifamily products, the office and industrial, retail, hotel, all of that. And they also break it down by urban, which is like infill, or suburban, or also downtown, right? So for instance, for Nashville, what we're researching right now, we'll see that for the first half of 2022, in the South, oh no, this is South. Yeah, in Nashville, it's 3 to 3.5% for Class A stabilized products. Now for Class A value add products, you'll see higher, obviously, since there's more potential to increase that NOI. So 3.75 to 4.5, and then 4.25 to 5% for this half period. So seeing some upticks in cap rates, and I guess that's just a result either of declining property values, or also more value add opportunities where you can bump up or get your rents up to market. You can address some CapEx items, rehab some units, turn some units, and realize better rents, right? So that's the results of the types of products that are out there in the market, obviously, but that's kind of what's happening there. And then you got some sub markets, or suburban markets, that is. I don't think Nashville. Oh, they do have suburban Nashville. Suburban Nashville is a little bit less, or kind of on the same page, maybe even higher than infill Nashville, which is urban. So yeah, a little bit higher for suburban, maybe some more opportunities there. So yeah, that's cap rate. Now, obviously, your going in cap rate is a huge indicator of whether you're or not you'll see that yield on cost spread in that market. So this is one thing that I recommend just solidifying right off the bat, and verifying also with a few other sources. So what I use, again, for cap rates, another one is this NAR report. So that gives a good indicator of market cap rates per asset class. Some of this is lagged, so keep in mind that some of it is a little bit lagged, just given the speed to market data. But you'll see here that for multifamily across that entire submarket of Nashville, or this is Knoxville, there's Chattanooga, there's Knoxville, Memphis, here's Nashville. Okay. So see here that it's 4.5% in the third quarter of 2022. So this is more of an average of suburban, infill, downtown, all of that kind of like averaged out maybe. So 4.5% is around about like what you'll see there. And if you ask brokers, get their opinion on this, they'll probably say the same thing, like somewhere around like 4.75 or 5%, somewhere around there. And then, but the good thing about like a report from a brokerage firm is that they kind of just specify which particular area of that market is operating better than others. So that's just a good thing to keep in mind. And yeah, obviously just knowing that as a broker, right, if you're a seller side broker, you're more incentivized to list your product at a very attractive cap rate. So whether that's if you underwrote for or did your pro forma or financial analysis and you realized a really good NOI, that could affect your cap rate, right? Whether the seller is maybe a little bit hesitant to sell it at that price, right? And they realize that their property is not actually of that evaluation, then they could realize a lower or ask for a lower asking price, and that could affect the cap rate, right? So these are all like sensitivities that can affect the cap rate, but just knowing that having an attractive cap rate is a very good offering memorandum technique on any type of report. And it's also, if you think about it, it's kind of a double-edged sword in that sense, because a higher cap rate means that the investor has to realize a higher yield on cost to justify their investment, right? And that also could get affected by whatever their interpretation of the cap rate is according to their underwriting, right? And verifying the NOI assumption. But it also could directly be affected by someone who isn't that much knowledgeable or doesn't want to do the underwriting for themselves and see what the actual value is, right? So that's a good thing to keep in mind. And what I do, obviously, I compare yield on cost to market cap rate first, the seller's underwritten cap rate, which is their stabilized NOI divided by their pricing guidance, right? And then also the investor's underwritten cap rate, which is basically you're taking your or the seller's current NOI, verifying that that's actually the NOI, and then also applying whatever growth rate of NOI that you're projected in that market, right? So if you're planning to do like a 50 basis point cap rate expansion over a 5-year hold period, this is the typical example I use, but 50 basis point cap rate expansion over a 5-year hold period, that means your NOI is growing by 2% per year, right? So applying that NOI growth rate to that value, and then also seeing if what that seller has for their stabilized NOI, and seeing if it's just unreasonable, like maybe like a 20% NOI growth, 15% NOI growth. And you can kind of verify that and just see like, hey, that's unachievable at this point. Your occupancy is fantastic at this point. There's minimal room to expand that NOI, right? So just making sure that you're mitigating some of those like areas within both the cap rate calculation as well as your yield on cost calculation, depending on whatever CapEx budget that you have in place. That's a wise thing to do. And yeah, and then obviously the market cap rate is something that will affect your decision whether you want to invest in it or not. And especially if it's like a local like submarket, right? What you can do is just pull some sales comps or some recent selling activity in that area. And if you can get some access to like average cap rates within that area, maybe with a site like Yardi or CoStar or from your buyer side broker, that could also give you some insights as far as where you're at and where you can match and outperform the neighboring products, right? So those are just some like kind of higher level techniques that I can think of. But that's kind of my interpretation on that. And yeah, obviously, if you're a seller, selling it at like an attractive price will have implications on a lower cap rate, and that's just a natural thing. But I always recommend that when you're underwriting it from the buyer's perspective, you always give a higher cap rate at the disposition period, exit cap rate, that is. So whether that's like even like a 25 basis point expansion or a 50 basis point expansion, you're trying to sell your asset at the most attractive price and also the most attractive performance, which is NOI, right? So you're trying to maximize NOI, drive NOI over the hold period, and realize that fantastic exit cap rate. So that's kind of like the ideal situation. But obviously it doesn't really work out for a lot of property owners. But that's just my interpretation. And also just let me know what you think as far as that initial yield on cost tests and cap rate evaluation. But yeah, so I already rambled there a little bit. Sorry about that. But that is my quick market research that I perform for a given market, submarket, tertiary market. And just knowing that a lot of these sources are free is a huge boost to people who maybe aren't ready to invest in one of those higher level tech databases, and they just want to do their own like solid market research and find out what is happening in their market. And if you think about it, a lot of brokerage firms, they post all of these reports, market reports, mortgage reports, cap rate reports, investor sentiment reports, right? So all of these reports are from the data that they use from the popular sites like Yardi, CoStar, RealPage, all that, right? So if you think about it, leveraging some of their reports, which are free and they're on their website, and formulating like your own opinion or keeping up to date, honestly, I think the more consistent you are with your market research, the better you'll get at evaluating markets. So those are just some tips that I can think off the bat. But this is all like preliminary stuff. Once you get into your actual deal, there's so many more risks, like I mentioned with my breakdown here, of risks that you need to mitigate, right? So it's a relationship business, as they say, and having those connections with your contractor, your partners, right? Your brokers, your lenders, your architects, engineers, if you're doing a more complex project, and then obviously your property managers to solidify all of those underwriting assumptions is key. So yeah, and then other things that I mentioned were the operational plan, and then also the initial condition assessment. So yeah, let me know your thoughts on all of this. I know it was a lot to intake, but this is how you start. This is how you start your business plan. This is how you formulate your investment strategy when you're going into a market where you may not have as much local expertise, right? So yeah, thanks again for watching. Feel free to like, comment, share. If you are active on LinkedIn, feel free to hit me up, Abin Savani, that is. And also, if you would like to join these podcasts or videos, just give me an email and we can hop on a quick call for that. So thanks again for tuning in, and have a blessed day, and enjoy the summertime as the weather gets a little bit warmer out there. So yeah, awesome. Have a great day.